For Morningstar, I'm Jeremy Glazer. There weren't a lot of marquee data reports this week, but Morningstar's Bob Johnson, our Director of Economic Analysis, thinks there still were some clues as to what's happening in the economy. Bob, thanks for joining me.
Great to be here today.
Let's start with the small business confidence report. Is something you watch pretty closely. How do business owners think about the state of the economy right now?
Not so great, at least about their businesses. Their reading was 92.9. That was down from the previous month, and it's the lowest in many months. In fact, I don't think we had a reading that low all of 2015. So clearly they're a bit worried, and I think a lot of the worry stems from earnings expectations, which aren't so good right now. So it was a disappointing headline number. We had expected that business owners would be a bit worried in December and January when the surveys came out, and they weren't as worried as we feared. And that was, of course, when we had all the market turmoil going on. And as it turns out, the panic seemed to more hit in February.
Beyond that headline number, there's some employment data about expectations of hiring or wage increases. What did that show?
Yeah. Let's go with the hiring first. That was down a little bit. Their hiring intent was not as bold as it once was. And the other thing that we always look at there is the number of people that said it was hard to fill a job. And that fell rather dramatically from the high 40s to kind of the low to mid 40s between January and February. So I guess that's not entirely good news when it's entirely bad news, that is, because it does mean that we're able to find more qualified employment, and that's good news.
And then on the wage front, do they expect to be giving a lot of raises soon?
Well, those numbers kind of dropped off, both in what they paid in actual raises over the last 3 months and what they intend to do. Both those numbers were down from really high levels in January, but they're still at pretty high levels. And you pair the low expectations for being able to raise prices with the fact that they are still, not as much as before, but still intending to raise wages, that certainly puts some pressure on incomes. And I think that's what's really got the small business owner concerned, is that it's nearly impossible to pass on a price increase right now because consumers have so many outlets to shop and to choose from. So that's clearly a big concern that they're not able to raise prices, in fact having to reduce them in some cases. And at the same time, their expenses are going up, namely labor.
Moving to Washington, we got an update on the budget deficit. What's happening there?
Yeah, the news there was surprisingly good through the first 5 months of the fiscal year, which started back in September. The budget deficit's about flat when you do all the adjustments compared to a year ago. And given some of the legislation we saw back in December and a couple of other factors, we still are expecting for the full year the budget deficit to widen. But so far in the first 5 months, it hasn't, primarily because tax collections have been unusually strong, especially on the individual side. And on the individual side, strongest in people that are kind of submitting taxes, people that kind of work on their own or people that are doing their capital gains tax payments and so forth. That category was up well over 7%. So clearly that helped the take side, if you will, and probably made the budget deficit come out a little bit better than many of us had been expecting.
So if the federal balance sheet maybe is not getting any worse, the consumer balance sheet is also something we've been focused on. Do we get any information on the state of the consumer this week?
Yeah, we did, and that was a little bit worrisome. I mean, it's great if you're in the camp of, well, debt is bad, and any slow growth in debt is good news, but we did add an incredibly small amount to consumer credit in January, and that number was we added only $10 billion, and the expectation was that we'd add well over $20 billion. And that's often an indicator of what's happening with consumer spending. So it doesn't particularly bode well for the months ahead in terms of spending because this is an interesting measure of consumer confidence. And that debt that we're talking about includes credit cards, student loans, auto loans. And that number seems to have kind of stabilized. There was a pretty high number in the previous month, but in this reading, we kind of cut that expenditure in half. So clearly the debt levels, which is usually good news, that consumers are being conservative, that the numbers aren't being boosted by consumers borrowing unnaturally. So on that side, it's good. On the other side, it might indicate their confidence isn't as high as we'd like to see.
Perhaps some mixed messages this week, but you still see no signs of things really falling off the cliff.
No, I don't see anything that's falling apart, but there's certainly some things here that's saying maybe a number here and there that we've seen that says things are all kind of hunky-dory and good again. Might just be a bounce back from the bad December data, and that nothing special is happening here in February or March. So we're still on track to do a relatively low, kind of bottom of the 2 to 2.5% range for GDP growth in 2016.
Bob, thanks for the update.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.